who took the time to join today. Looking forward to a great program from Nick. Um, I am going to introduce Louis Mesa, who is a director at Moody's. I've known Louis for several years, and we've had conversations about the Moody's Market Pro platform, and that I think will be of interest to everybody on the call. And I will turn it over to Louis now and take it away.
Thank you. Good morning, everyone. My name's again Luis Mesa. I am with the Moody's Commercial Real Estate team. For those of you that are not familiar with the services that we do provide, Moody's has been in the commercial real estate space now for over 5 years. We have a brand new product that we launched at the beginning of the year called Moody's Market Pro. This is a web-based portal that tracks over 8.5 million commercial properties throughout the United States. And so, what I'd like to do before I introduce our guest speaker today, which is our economist, just like to take a few minutes just to give you a little bit of an overview of what it is that we do offer. So, just bear with me for 1 second here. I'm just trying to share my screen. There we go. So what I'd like to do over the next couple of minutes is just introduce you to our new platform that we've just rolled out here at the beginning of the year. This is our new product that tracks over 8.5 million commercial real estate properties throughout the U.S. The system's very user intuitive, so it does give you the ability to go into any market. So I'm just going to randomly select here Denver, Colorado as an example. We are tracking all the different inventory throughout any given market throughout the United States. So you have the ability to come in here and add a zip code or a city or a specific address for a property. We do track all the different segments of commercial. So everything from retail, office, industrial, which are the core four. Within all the different segments of commercial, we do have subsets of commercial for, excuse me, for retail, for example, you can see all the different subsets. If I were to go into office, for example, all the different subsets of office. Same thing with industrial as well. And we do that for all the different segments that we do track. Within our database, we do track extensive loan information, everything from Fannie Mae, Freddie Mac, to CMBS loan level information. We do have a lot of different filtering tools that are built into the product. So you have the ability to look for delinquent loans. If you want to search by specific loan amounts, maturity dates, or perhaps even loans that are in special servicing, you have the ability to do that. So just to do a quick search, for example, of properties in the Denver market that are available for lease, I can scroll over to the right here and I can select a building. Within the building, as you can see here, we're going to have photographs of the property, all the different property attributes. We do track all the listing level information, so all the listings that are being loaded by either the brokers or owners that do want to market their listings, you have the ability to do that. We do track historical information on every building, including any previous flyers that were loaded historically for properties that have either leased or properties that are currently available for lease, or if the property is sold, we would have information about that as well. We do track all the different tenants for every building. So every building would have all the tenants, including suite numbers, as well as phone numbers, and the type of business that they operate. Under the Contacts tab, we'll have the key agents that are responsible for the listings. We will have the legal ownership information, as well as true ownership contact information as well. And we do have some other features built in. We do track all the energies and emissions policies that are applicable to any government regulations in that specific market. So that's been streamlined for you to be able to find that information. We also do have a commercial location score for every building. Essentially, we assign every property within our database a score. It's comprised of these 6 different attributes that you see here. I won't get into it here today, but it's a unique feature that we offered here at Moody's. And then from a performance standpoint, we do track historical level information for the property. We do estimate cap rates for every building within our database as well. And I can certainly explain that at a later meeting and how we arrive at that information as well. So we have a lot of exciting things that we built for the industry. Just wanted to make you aware that we are an alternative data source for you, and really just wanted to thank you for your time this morning. I'd like to go ahead and introduce you to my colleague, Nick Luettke, who will be providing you with a economic overview and presentation here this morning. So thank you again.
Cool. Thanks, Lewis. Let me go ahead and share my screen for everyone. Okay. Well, thanks for having me. I wanted to start off by saying that. I'm looking forward to this discussion today. I'll give a little bit of background about myself before we get started. I'm originally from Michigan, currently living in Arlington, Virginia. I have a master's degree in politics, economics, and philosophy from the University of Hamburg in Germany. I also have a master's degree in international relations with a focus on international political economy from the George Washington University, which originally is what brought me here to DC. So I've broken down this presentation today into kind of two factors. The first is the macroeconomy, kind of an overview of the year of 2025, what we have seen, and kind of what we're going to see hopefully in 2026. And then get into CRE sectors and their own performance. So I designed it in a way that's kind of a year-end review and with a bit of looking ahead over the course of the next year. If you have any questions, if they're related to a specific data point or something's unclear, feel free to unmute and ask, and I can address it then. If you have kind of a broader question that might lead to a larger discussion, I should have about 10-15 minutes at the end for those questions. So I will go ahead and get us started. I'll start with, of course, the big heavy hitter that everyone always starts with, which is GDP growth. It's been quite a wild year. We're forecasting, our baseline forecast expects that the 2025 will end with 1.5% GDP growth for the year. We're obviously still waiting for Q4 to finish up and get that data. You can really see in this graph how wild of a swing we had between Q1 and Q2 in terms of performance, as companies raced ahead with imports before tariffs were being implemented and the uncertainty that led to. But then, of course, a strong second quarter performance in response to that, with third quarter performance moderating out. You can see as we're moving forward in expectations, we expect a larger level of stability in our baseline forecast relative to what we've seen, especially as imports, which is this purple, have really settled down and should remain much more stable. One of the big things with GDP this year was how is tariffs and implemented tariffs going to affect GDP growth. This is a really interesting visual because I think it summarizes 2025 quite well, the level of chaos that we've seen with tariffs and how all over the place they've been. You'll notice the green line, that's the US effective tariff rate, has remained substantially lower than the statutory tariff rate. That's because of exemptions. It takes time to implement, substitution effects. For all these reasons, the actual green observed effective tariff rate hasn't been as significant as kind of expectations were at the start of the year. If we place ourselves back in January, February, the level of uncertainty was extremely high. And I think as far as tariffs and trade, we've seen that, yes, there was a lot of disruption and there were moments of chaos. But fortunately, a lot of deals have been made. And even where there is some remaining instability, I don't expect the tariff negotiations to go away moving forward with the current administration. They certainly seem to use it as a tool for broader foreign policy. It's likely here to stay. But at the same time, perhaps the level of uncertainty has been reduced and there's a little bit more of a playbook to understanding what's going on when we start to see tariff negotiations. None of the tensions with different countries, whether they be in Europe, the Pacific, Asia, or even our neighbors in Mexico and Canada, Luckily, none of them have really turned into a full-blown trade war. So we'll see where the U.S. Effective tariff rate eventually settles. We're forecasting and anticipating that it'll end up at about 12% over the next year. So a lot of tariff policy is settling in. However, one area where we expect tariffs to continue to have an effect is regarding inflation. This is one of those things that was really a matter of perspective. There was a lot of anxiety over how much inflation might pick back up as tariffs have been implemented throughout the year for a variety of reasons, either corporate decisions, uncertainty over the permanency of it, and kind of just hesitation to be the first companies to start raising prices again after the pain that so many Americans felt in 21 and 22 from inflation. We haven't really seen inflation pick back up. We're expecting that because of tariffs, it'll end up somewhere between that 3 to 4% range. And as far as the CPI goes, we see that month to month, most months, we're seeing a small uptick in inflation pressures, but we haven't seen a kind of takeoff. Inflation expectations from consumers remains higher than kind of observed levels, which is always a dangerous sign. Because of inflation, observed inflation really does start to take off, and that inflation narrative takes hold with the American consumer. Inflation expectations can play a role in accelerating inflation, but hopefully it will remain below what we saw a couple of years ago. On the other hand, if you're going to talk about inflation, you also, of course, have to talk about employment. The Fed has the dual mandate. They're supposed to manage both inflation levels and employment levels. And we've seen, this is no secret, a slowdown in the labor market. Hiring is steadily moving downwards. You do have some months that are outperforming others, but over the course of the year, the labor market has really moved into a period of stagnation. I think that's the term that I like the most that describes it. We're still seeing layoffs are relatively low. They're picking up towards the end of the year, but relative to previous recessions, they're quite low. But we're also seeing hiring remain extremely low. People aren't quitting their jobs. They're not looking to move to new jobs. People are holding on to what they have if they have it, and struggling to get a position if they don't have one. I think probably all of us in this call have had conversations with people on the job market, and they've likely shared just how challenging of an environment it is at the moment. But hopefully layoffs remain low in the year ahead. As you can see, our dotted blue line at the end, we are forecasting it to remain fairly stalled out over the next year. This is a combination of the elephant in the room of AI, but it's also a matter of a little bit of a correction from extreme hiring levels in 2021 and 2022. A lot of companies have been trying to adjust their policies since then, when they both, in some cases, over hired and over promoted. So we're even seeing in some firms some layoffs, but then also some hiring at lower levels. This is a little bit of a longer view. I'll go back to this other slide. You can see that this is just really the last couple of years. When you take a look at the longer view, what we see is, once again, that level of stagnation. We're just not expecting to see much growth in the year ahead. But compared to recent years with COVID and the negativity, then the rebound, and this kind of highlights what I was talking about with the recession, previous recessions. Let me move my camera here. Sorry about that. I'll draw your eye, if you can see my mouse, in particular to this purple line. And I think that's part of the reason why the labor market over the course of the year has been softening and being described as softening, is that healthcare has been a real positive force in recent years as far as the labor market's gone. And that is starting to slow down as well. And so we're expecting that to continue, with healthcare falling more in line with growth rates of other sectors. And so I think that's also part of the discrepancy, especially early in the year, when a lot of people were trying to get jobs, were highlighting their inability to get them. Consumer confidence has been decreasing and it has remained low. And a large part of that is that if you didn't work in healthcare or healthcare related industries, hiring has been low throughout most of the year. Another factor that's interesting to observe is there's been a clear change when you look at foreign born versus native born in hiring in the labor market. This is no secret. Immigration policy and reform has been a major story throughout the year. I think interestingly, and we'll see how immigration policy continues to develop, you have both the lower skilled end of policy and restrictions on entering the country or undocumented workers and their ability to find work in the country. You also have the higher skilled H-1B restrictions, and that remains a point of kind of contention for the administration, even within the Republican Party, on how that policy should look moving forward. So we can see that the labor force is kind of stalled out with this change between native-born and foreign-born performance. Okay, so I'm going to spend a couple minutes on this slide. If I had to really think of a slide that I think tells the story of the economy in 2025, it might be this one. That's for two key reasons. So the first is it does a great job of showing this K-shaped economy that everyone's been talking about, that higher income earners are doing better. They're still spending. The sense that the economy is doing well still exists. There's been a lot of gains, especially if you're a higher income earner invested in capital markets, that you've benefited from those gains over the course of the year, whereas lower and middle income earners are not performing nearly as well. And that is, of course, the idea behind the K-shaped economy in the end. It's also really interesting because it kind of helps explain this idea of the missing middle and the weakening middle class that America has observed over the course of the last decade or two. And you can see that the red line with middle income earners, they're behaving in similar ways to lower income earners now. And so it's less of the middle class has been weakened, and there appears to be a good amount of anxiety, which also helps explain why consumer confidence is so low despite economic growth overall. These high income earners are really helping keep economic growth afloat. Part of the reason why GDP growth has been as high this year is because spending levels have remained higher. They're slowing towards the end of the year. We're seeing that in the most recent months. But if we look over the course of the year, high income earners have been key. So in that first part, the K-shaped economy, this graph does a great job of showing that K-shaped economy. But the second way in which I think this is a great slide is I want to talk about what I see as the downside risk of our baseline forecast moving ahead. And that's the kind of AI paradox. I haven't really thought of a good way to describe it, but it certainly feels like we're walking along a ridge right now with very steep down slopes on either side. And this graph highlights why. If you think about who's invested in the markets, it's going to be these high income earners. So if we take I'll explain how I see there's downside risk on both sides of the AI story. If you think that there's a financial bubble, if you look at the stock market and think that the stocks are overvalued, the bubble's going to burst, and that AI is not going to be as successful as investment has warranted, it's these high income earners who are most heavily invested, both in their retirements, their 401ks, but also through retail investing and trying to capture recent gains and performance of the stock market. If you're a middle income earner, you're making median household income in America, we see you probably don't have much money saved right now. Debts are rising, delinquencies are rising as well. And so most of the concentration of investment is on these high income earners. So if the bubble bursts and there's a pullback from high income earners as they see their investments weakened, this could lead to kind of a recession in the year ahead from the pullback in spending. At the same time, the other risk is that there is not a stock market bubble, that in fact, the investments in AI, both in terms of stocks, but also in terms of the actual physical production, all the data centers, companies, investments, their relationships with one another, that all of these are warranted and justified because AI is so successful. There's a high likelihood, I would say, that we're going to see an uptick in layoffs or at least an increased slowdown in hiring. And we know that AI is a group that normally is not as vulnerable to these sorts of layoffs is high income earners, white collar workers, college educated, oftentimes with post college degrees now. If those jobs are lost, or at least there's a sense that those jobs will be lost because of AI, you can once again have a pullback in spending from this high income earner group. So in many ways, our economy has kind of put our eggs in the basket of high income earners and their ability and willingness to continue spending. And so it doesn't mean we're necessarily doomed. I don't think that would be my analysis with AI in the year ahead. It's entirely possible we walk along that ridge and things remain stable. I think what that would look like is that AI productivity continues to advance, but it doesn't get to the point where significant levels of layoffs of white collar workers happen. If it does get to that state, there's going to be significant downstream weakness. And on the other side, financial bubbles don't always lead to recessions, but this appears to be a prime example of where it very likely would when spending gets pulled back due to losses. So when we put this all together, this is how the Fed funds rate has changed, how the FOMC has moved. We are expecting another cut here in December in our baseline forecast. I think interestingly, if there's anything I'll point out, is we're expecting rate cuts to continue throughout the next year, both in terms of kind of macroeconomic policy as well as changes in the Federal Reserve that are likely to happen. We actually don't expect that this will affect things like the 30-year fixed rate mortgage or 10-year or 2-year treasury yields. Well, we think that there's a lot of expectations already built into these rate cuts, which you always get into interesting games when expectations start to get ahead of official policy and what happens when there's a little bit of instability or the FOMC doesn't act in the way that's already baked in. So that's something to look out for in the year ahead. And this is our economic outlook for the year ahead. The forecast here is here because we have not officially finished 25, although we have more information. We're expecting to see a similar year ahead in 26 with better growth in 27, 28. We still expect unemployment to stay below 5%. So hopefully this holds true and we don't have an uptick in further weakening and softening in the labor market that we've observed. I would also summarize this year as one that's been interesting for expectations. At the start of the year, there were a lot of recession calls that didn't end up happening for reasons like AI, productivity gains, and tariff policy not being as extreme and problematic as initially expected. There were recession calls. We had low single, just above 0% GDP growth in our own model. Over the course of the year, that's been raised a couple of times to now 1.5%, which is, I think if you told most people at the start of the year, the US economy would avoid a recession and grow by 1.5%, I think a lot of people would take that. Okay, I'll move on to CRE sectors. I want to start with multifamily. Multifamily is in a really interesting position right now. It's interesting because I think if you look at both the blue line for vacancy rate and the effective rent change here in green, it looks like a period of stagnation, but I think that would be misrepresenting it. It's really a period of absorption that's happening. You know, we've had record level of construction over the last couple of years. I'll get to that in just a second. What we've seen is that the vacancy rate is stayed flat despite still strong growth throughout this year. And we're currently at 6.5%. We did see weakening in the effective rent. You can see the very last data point in Q3 was negative nationally for effective rents, which was going against our expectations in the grain originally. And we expect that to continue here in Q4, although we expect year over year to remain in positive territory. And so we can see this is the construction visualized. In blue is completion levels, that's our data. In the green is a 12-month rolling average of census starts. You can see, especially if you look right here, our blue line does track pretty well with about a 2-year delay for construction between starts and completions. And so there's interesting stuff going on. We think record completions occurred in 2024. We're expecting about a 15% decline here in 2025, and we're on target to hit that 15%. And we think we'll lose another 15% in 2026 and another 15% in 2027. So our blue line has just started to decline, whereas the green line for starts has already declined significantly in recent years. We expect our blue line to then track that. However, I'd also point out that despite momentum being on slowing completions. Completions as a total figure still remain quite elevated, right? If you look at our current data point here, it's still quite high compared to the pre-pandemic, especially the time related to the GFC. And so this is largely positive as new construction needs to have time to get absorbed. Part of it is the story of interest rates and slowing construction, but part of it, and I'm sure many of you on this call know, is just needing time to absorb new development before continuing at the same pace that we have been. You can also see that there's a gap between Class A and Class B and C performance in recent years. This relates to challenge, it's kind of two stories going on here at the same time. The first is that it makes sense that Class A vacancy rates would be higher given the level of new construction over the last decade. We've expanded our national inventory by over 25% in just 10 years. And most of that's going to be Class A properties. So it then would make sense that Class A vacancy rate would pick up ahead of Class B and C. At the same time, this also kind of identifies and helps show the affordability crisis that Americans are facing, that there still are a lot of people looking for Class B and C units, given their cheaper price. I did not include it here, but if you look at affordable housing, the rates are even lower, very close to zero, with many metros having wait lists for people to be able to get these units. So the affordability story is also playing a role here as Class A units become unaffordable for many people. Within kind of the regions, we've also seen a sharper slowdown in the Sun Belt than pretty much anywhere else, whereas we've seen an uptick in completions in the Snow Belt. We can see the effects, especially here on the vacancy rate on the right-hand side. There's questions, of course, in certain markets in the Sun Belt. Has there been an overexpansion? I think that's entirely dependent on the market and the fundamentals within the market. So it's tough to say from a kind of regional perspective, but we do see that at least temporarily there's an increase in the vacancy rate. Now the question becomes, how long does that remain the case for markets in the Sun Belt? And while we're positive here on the Snow Belt, and I think this data does a good job of showing it, I should also mention I'm a Midwesterner myself, and I think there's also performance. If you get at the metro level, there's significant performance gaps between the Rust Belt and the non-Rust Belt. So Detroit, Cleveland are not having the same performance as Minneapolis and Indianapolis. So just as the Sun Belt had a good amount of performance gap across different states and different markets, I think that's true of a shift towards the Snow Belt and the Midwest. It'll be interesting to see, if we're talking about that affordability issue, whether or not that really starts to affect migration patterns. We haven't seen that tick up too significantly for a lot of these markets, even though there are better deals to be had throughout much of the Midwest and Northeast with the Snow Belt. We haven't seen migration reflect that. So my final multifamily slide here, I think there's a lot of information here. I'm not going to be able to have time to talk about it all, but you can especially see on the right-hand side is, well, actually first on the left-hand side is the way in which there's just been a general cooling of operating expense cost rises. We see that repairs and maintenance have really been cut as operators are trying to balance their books and with rent growth being so low, manage their revenue versus operating expenses. But the big story, of course, is that utilities are spiking. That's not just for multifamily. This is for Americans broadly. Energy costs are rising. There's a couple of different reasons for that. Natural gas is up slightly. There's, of course, data centers and the power consumption from data centers, although that seems to be a very controversial topic, whether or not it's actually raising energy prices. But broadly, utilities and costs are on the rise, and this might be a key story if that continues throughout 2026, if Americans are paying more and more for utilities and especially energy. So a little bit more of a niche topic here, but it's one that I cover for our team, and I think is absolutely interesting and worth keeping an eye on in case you haven't followed this story too much. You can see on the left-hand side, senior housing went through a massive shock with the pandemic. There was the very real loss of life. There was concern about living in communities for exposure, and there was lifestyle restrictions, and they all played a role in seeing vacancy rates fly upwards. But the recovery has also been quicker than I think almost anybody expected. We are now at a vacancy rate of 9.1% nationally for senior housing, which is actually lower than it was pre-pandemic. It's back to 2018 levels. You can see on the right-hand side, the rent growth story is fascinating. It's the inverse of multifamily. I will go back here real quick. You can see the green line more in green bars more in 21 and 22 being stronger, with weakening performance since then. Whereas if you turn here, we actually see that because of that high vacancy rate, there was missed rent growth during the inflationary period that's now being moved on to renters. That being said, despite it climbing here, rent growth remains well below CPI growth. It remains well below multifamily growth. Senior housing operation is expensive. There's a lot of the reason it's so expensive has to do with labor. So the wages you have to pay the laborers has gone up ahead of rent, but affordability is such a constraint that you really can't raise your rent too much more than what we've been seeing here, because the risk of losing tenants is just so strong in their ability to pay. Inventory growth has remained exceptionally low because of this reason. It's difficult to operate senior housing despite the vacancy rate moving downwards. But it really gets interesting when you start to consider the silver tsunami moving ahead. This is no secret. Baby boomers, we've been talking about it pretty much my entire life, the aging baby boomer generation. But you can see it visually here that many of the elderly demographic groups are going to be continue getting larger over the course of the next couple of decades. And so there's certain fundamentals that point towards senior housing being a sector that's likely to see a significant amount of growth. There's other factors such as wages and kind of overall cost and challenges of operating them that also discourage it. I'm excited to see kind of which way it breaks and when we start seeing greater level of construction of senior housing again moving forward, because we just haven't started to see it yet. Turning to office for the year, the vacancy rate has increased throughout the year. It's now at 20.7%. That's a record level. It started pre-pandemic in 2019 Q4. It was 16.8%. So pretty substantial rise over the last couple of years. This is no secret. Our previous peaks were at 19.3%. That was set in 1991 and 1986. 1991 was the savings and loan crisis. 86 was from a sizable development period in the 80s. But we've seen other peaks, usually are in times of recessions. We've obviously avoided a recession. There's been greater increases in RTO mandates and return to offices, and yet the vacancy rate has continued to move up as the shifting landscape of office using employment changes. That's of course kind of long-term changes in behavior. Despite a lot of RTO mandates, their enforcement is mixed, a lot of hybrid work still, and a reduction in footprint for companies that no longer feel the need to have huge offices with a ton of cubicles, but rather a lot more flexible space, which they can lease smaller quantities of. Subletting remains a key hurdle to that vacancy rate. We see subletting still remains quite high. It hasn't started to decline all that much. You'd probably need to see this start to decline before the vacancy rate declines. I will say real quick on this slide, I forgot to mention, we are expecting it to continue to rise throughout 2027. I wouldn't be surprised if that continues, if that's not only accurate, but if the pace upticks, especially if the labor market continues to sour, if office using employment sours. But once again, even if the economy remains strong and office using employment remains strong, there's always downside risk, if AI advancements proceed in a way which the overall economy remains strong, but white collar workers are reduced in total numbers. So office remains in a point of distress. I think this is one of the more interesting developments that we've observed in our data in recent years, which is the flight to quality that it was occurring in the first immediate reaction to the pandemic has slowed. Class A properties have not been performing nearly as well as they were in years prior. Class B and C have been much steadier in their levels of occupied stock. I think there's a couple of reasons for this. One, we don't disaggregate between Class A and kind of like trophy properties or Class A plus. We get the sense talking with people and hearing from others that these properties, the top 5-10%, are still doing quite well. They're still benefiting from the flight to quality, but that some of the other Class A properties that might be a little older, built around the GFC timing, were able to leverage their newer positions in the decade prior to the pandemic, have now aged and are now struggling to kind of make the good deals. The other part is that there may have been great deals to be had in 2020, 2021, and 2022 that have kind of eased over time as owners and operators of the buildings want to make more money. And so they're less willing to cut the sort of deals that were occurring and motivating this Class A performance before. A colleague of mine did this interesting breakdown for us, and I think it totally matches up with kind of sense and expectations, which he broke down at the submarket level, submarkets into 9 to 5 urban, mixed urban, or suburban. If a submarket has more than 45% of its CRE property is office space compared to multifamily or retail, so 45% or more office, we classify it a 9 to 5 urban. So if you think about your downtown CBDs or your areas with concentrated business parks, even if it's outside the downtown, we see that these have continued to struggle, and that's is, I think, not necessarily all that surprising. Mixed urban is between 24% and that 45%. And then that, of course, leaves suburban as 24% or less. And so this has been a trend, and usually we talk about it actually in terms of retail, that mixed use space, mixed use neighborhoods have been a great story of success for retail over the last decade or two. That, out with the old malls, out with cities where they design retail in this part of the city and office in this part of the city and housing over here, that really people want the mixed use spaces. They want to be able to live closer to work, shop closer where they work, and kind of spend less time commuting in cars. So mixed urban, it makes sense that they've seen the best performance. On top of this, I think a secondary factor is that might be part of kind of urban revitalization plans. And as cities do urban planning and kind of focus on this mixed use space, these might be the newer, hotter areas. And so it would logically follow then that offices in these kind of whatever city you live in, if you think about the hot neighborhood, it's probably has a solid amount of all three of those property types. And we can see the performance there. Turning to retail. Retail is one where we've seen the vacancy rate hold very flat. Effective rent growth has remained strong relative to previous years, I should say, when the pandemic really scared things. It's remained steady. Of course, malls are a story that continues to remain top of mind. Sometimes it gets overblown. There are malls that continue to be successful. I live right near one, and there's always people walking through, and they seem to be doing just fine. Part of it too is, if you would think about that consumer spending graph I showed you early on, high income earners are still out shopping and still spending, and so malls that have been able to capture that spending levels have done well, whereas a lot of other retail in more mixed use space, smaller spaces, have embraced e-commerce, embraced kind of omnichannel methods. And we see retail holding pretty steady despite anxiety kind of over retail sales. So I'm going to show you now over the next two graphs both consumer confidence and consumer spending levels. I'll also acknowledge that just because consumer confidence or consumer spending declines doesn't necessarily lead to an uptick in retail vacancy rates. A lot of times people are strategizing in retail in longer time horizons than kind of spending levels would necessarily indicate. But of course, anxiety in confidence and spending can affect new or existing retailers and their willingness to sign leases in certain environments. Consumer confidence is now low. It's basically at pandemic era levels, which is quite scary. This is both the Conference Board and the University of Michigan sentiment. It's been steadily decreasing. Hopefully it doesn't decrease too much more, but there's a gap. And that gap is that consumer confidence has remained low. When we look at a good amount of retail spending, it's the story is that things are slowing, but still positive. And I think that that's key. We haven't started to see a decrease in a lot of retail sales statistics. And so the question is, how does this gap get broken? Is it going to be that Americans continue to spend throughout the holiday season, things actually steady out a little bit, and consumer confidence picks back up as a lot of anxiety is eased? That's entirely possible. It's also possible that this holiday season is going to be quite rough, and that once we start to get data on consumer spending, that it will instead align with lower consumer confidence levels. We have to wait to see how it breaks. But signs right now are uneasy, right? And this, of course, is important because not only for the retail sector, but for broader macroeconomic performance, could be a slowdown in retail sales can help kickstart kind of that negative recessionary cycle where people are hearing about layoffs and then pulling back their spending and adding to further layoffs. And so I think that's going to be a key story heading into 2026 is how consumers continue to spend or not. Okay. And so here we see a graph that shows e-commerce as percent of total retail sales. Interestingly, there was the shoot up during the pandemic. It eased. We have recaptured that loss since the pandemic as far as e-commerce. E-commerce continues to grow, continues to be a kind of central force within the new retail world and the new industrial world. And industrial has also undergone an interesting evolution over recent years. It's been one of those that's swung the most as policy shifts have occurred. But also the nature of development and the quick turnaround times has also led to some interesting dynamics, which I'll touch on in a minute. We see the vacancy rate is just under 8% now. It's steadied out and leveled out. Effective rent growth remains quite low. And this is largely because there was a huge demand boom. I'll go to the next slide. Huge demand boom in 2020 through 2022. Inventory growth started in response to that. There's then questions of overdevelopment here in 23, 24, and into 25, which help explain why you saw the vacancy rate first shoot downwards as demand outpaced supply growth, and then supply has caught up over time and led to a little bit more of a flat performance in industrial. Here are a couple of key markets, especially breaking down the West Coast industrial. I think this is very indicative of anxiety over tariff policy, especially as West Coast key hubs that have a stronger relationship with trade in Asia have seen their vacancy rates rise at quicker paces than most other areas, while effective rent growth remains negative. And so this is part of the story of industrial, is that there's also a divergence between kind of West Coast markets. You can see Houston, Phoenix, Dallas are all performing much better than the West Coast markets. And so there's significant regional variation going on. Talking about regional variation, we also see that a lot of classic industrial hubs didn't experience the same inventory growth, and so their vacancy rates and effective rent growths haven't moved as much. So if you look at huge hubs like once again Cleveland or Detroit, they had such a strong existing levels of inventory that they've performed a little bit differently than the national market. Okay, so just a final couple slides on capital markets. We expect that the CRE pricing recovery is going to be prolonged. We expect a good amount of steadiness, you can see, compared to recent years where it's been a little bit more up and down. But we do expect things to continue to remain relatively steady over the next couple of years. An interesting dynamic in 2025 here has been the gap between CRE lending and CRE sales, where lending has benefited from a lot of refinancing, and so it's outpaced sales levels. And so it'll be something to keep an eye on moving to 2026. Thank you for your time. I'm happy to take any questions if there are any.
Hey, Nick, Sim Dowdy with King Industrial Atlanta. How are you?
Good. How are you doing?
Great. You did a great job.
Thanks.
I'm going to agree and disagree with you, but it's based on assumptions, right? And
Yeah.
so I agree with you about the interest rates. They're going to cut them this week, and then they'll continue to cut next year. But I also think that the tariffs are going to get resolved. It's been really unsettling for the industrial market for sure, and for the Fortune 500. And it's made everybody pause. So nobody's hiring, nobody's firing, and all that. Energy costs, I believe, because you touched on that, I think they're going to go down because of deregulation and all that. And I think we're going to have a oversupply of energy, and we're going to be a exporter of energy. And so as those costs go down, because one of the things that caused inflation, energy costs had gone up, right? And so that caused transportation costs went up. Everything we buy in the store goes up. So I think once those things happen, I think certainty is going to come back into the marketplace. So the Fortune 500 people are actually going to start. There's been pent up demand. They haven't done anything for like 2.5, 3 years. And so once they have certainty and clarity, I think they're going to start expanding and hiring to move their businesses forward. So, and let's see, what else? I have a lot of notes here. So, because you did a great job.
Appreciate that.
I think that you talked about rent growth slowing. Well, in the industrial market, it has slowed, but that's after a 3 to 5 year explosion on rents. And so if you were paying $4 a foot in rents, all of a sudden your rent's now $12. And so these people that are paying $40,000 a year are now going to have to pay $120,000 a year on renewals. And so we're starting to see a lot of negative net absorption, but a lot of activity because people are downsizing because they just can't keep paying those numbers, right? So we've seen they've been offering free rent. They've been offering TI dollars, bigger commissions to brokers and all that, but they haven't been cutting rates that much, because they're trying to keep the value of the business up. And so, in Atlanta, we have over 130 million square feet of industrial space available now, which means I can't believe they're not going to start cutting rates. It's the most we've ever had. So I actually think next year is going to be great, but it's based upon the the interest rates for the Fed going down, and also tariffs getting fixed, right? And so, and energy costs going down. So I throw it back to you. What do you think?
No, I appreciate the comments. I will trust your industrial expertise here. I think you definitely have a more hands-on than I do with that. I'll say on energy is a really interesting state because so much of it is just reliant on geopolitics and how different events play out. What happens with Russia, Ukraine is going to be huge for energy markets broadly. Whether tensions or wars in the Middle East continue or whether there's a little bit of stability there. Of course, domestic politics and policy matters, but energy is such a international market that there's a ton of uncertainty, I would say. And then on the tariff policy, I think I would largely agree. I'll bring up the chart because I think it's helpful. I agree that it's likely to settle out, and I think people have generally settled down with it and accepted that there's going to be some shakiness, but not to necessarily overreact as much as people did at the start of the year in terms of announcements and initially applied tariffs and the negotiations that happen. I think that there's likely to may still be a good amount of tariff risk. The reason I think that is that the administration has changed tariff policy from a strictly economic policy, which I think bipartisan previous administrations have done, into now, and I think this is a shift that will continue after this administration, but one that is being used actively as a tool in the toolbox for international security. And so if the US is trying to work and develop a relationship with countries, they might use tariffs, the threat of tariffs as a way of bringing people to the table. At the same time, if tensions are rising in a kind of more security way, and the U.S. has a military or strategic interest in weakening a certain country, tariffs are also likely to remain a tool in the toolbox. So
well, I think there's one. I think there's one caveat here, though.
sure.
It has to do with the elections coming up, the midterms, and if they don't solve the tariff issue for right now, the Trump administration is going to get killed in the midterms because the economy needs to take off, and it's not if the tariffs continue like they've been. So I think they'll solve it because otherwise, and they may still get killed in the midterms. Usually the off years they get killed anyway. But if they don't solve it, they will get killed. So I think they will solve
it. Yeah, that's a fair point. It's a classic domestic politics versus international politics choice that they have, and it'll be interesting to see how it plays out, I think.
Yeah.
But thank you for your comments. I think that they all make sense. Yeah, thanks.
Anything else for Nick?
I think Joe's trying to speak, but he's on mute.
I'll jump in while Joe gets situated. One question I had was Sim mentioned the Fed. Where do you see the 10-year Treasury? It seems to be stabilizing a bit, lowering slightly. Is that a trend we can expect for 26, or where do you see that going?
Yeah, I think we're settling into a greater level of stability. I think what's really interesting here, and I mentioned this briefly in the presentation, is there's the expectation of the cuts being baked in. I think there's also then an expectation that inflation will continue to tick up, which is why you're seeing these levels kind of stick where they are. But a lot of the volatility that we saw earlier in the year, right? The first 6 months, 10-year Treasury yield was all over the place. And that had a lot to do with tariff policy uncertainty. So I think markets would agree that hopefully there's a greater degree of certainty, not only with tariffs and the effects that might have on inflation, but in terms of rate cuts. Of course, the Fed itself is about to undergo significant evolution. And so there is a degree of uncertainty for the organization and institution itself. But as far as kind of expected cuts, it seems as if there's such a level of market expectation. I think it'd be very hard for the Fed to do anything kind of other than what people are expecting at this point, which gets into a game of cat and mouse. So I'm always hesitant to say that too firmly because, suddenly there's a shock, there's a new geopolitical conflict or something changes and in broader international markets and those expected cuts become a lot less tenable.
I'm
So
actually,
hopefully that, sorry.
Thank you.
there's an IT guy in my office. I was shooing him away. I'm good. Thank you.
Any other questions for Nick? And while you're thinking about that, this session has been recorded. We will share it with you folks. Great information, Nick. Thank you for doing this.
Thank you.
Before we call it a session, anybody going once?
Okay, I'd make one last comment. I was at the SIR conference and last month, and usually when you ask everybody how's the next year going to go, it's 50-50 or 60-40 or 70-30. I didn't run into anybody that did not think we're going to rebound and have a good year. Not one person. And that's unusual. I never see that. So I'm hoping some good things coming. And by the way, don't give a broker a microphone. He'll use it.
The headline numbers are all suggesting hopefully we'll have a stable, improving year in the year ahead. The AI topic to me is going to be the number one determiner of that, and whether we're able to walk a fine line and keep the labor market from going negative. But it's good to hear optimism. It's a relief. It's been a lot of anxiety over the last couple of years.
All right. Thanks one more time, Nick. And everybody, thanks for tuning in. And we will share our 2026 programs with y'all coming up soon. So thanks for being here.
Thank you.
Great job.